Welcome to your journey into business valuation. I'm here to help you master one of the most important tools in investing, the price-to-earnings ratio, or PE ratio. By the end of this session, you'll understand exactly what this number means and how to use it confidently when evaluating stocks. So what exactly is a PE ratio? Think of it as the price tag the market puts on a company's earnings. Imagine you're buying a small business that makes $10,000 profit each year. If you pay $50,000 for that business, you're paying 5 times its annual earnings. That's essentially what a PE ratio of 5 means. The calculation is straightforward. Take the current stock price and divide it by the company's earnings per share. If Apple's stock trades at $150 per share and the company earned $6 per share last year, the PE ratio is 25. This means investors are willing to pay $25 for every dollar of annual earnings. But here's where it gets interesting. There are actually 2 types of PE ratios you need to know about. The trailing PE uses last year's actual earnings, while the forward PE uses analyst predictions for next year's earnings. Both tell different stories about how the market views the company's prospects. Let's look at a real example. Netflix might have a trailing PE of 30, meaning investors paid 30 times last year's earnings for the stock. But if analysts expect strong growth, the forward PE might be only 22. This suggests the market believes earnings will grow significantly, making today's price look more reasonable. Now, what makes a PE ratio high or low? Generally, a PE between 10 and 20 is considered moderate. Above 25 is typically viewed as expensive, while below 10 might indicate a bargain or potential problems. However, context is everything in valuation. Growth companies often command higher PE ratios because investors expect rapid earnings increases. Tesla, for instance, might trade at a PE of 60 because investors believe electric vehicle adoption will drive massive profit growth. Meanwhile, a utility company might have a PE of 12 because its earnings grow slowly but predictably. Industry comparisons are crucial for meaningful analysis. Comparing a tech startup's PE to a bank's PE is like comparing a race car to a freight train. They serve different purposes entirely. Software companies typically have higher PE ratios than manufacturing companies because their business models scale differently. Let's examine when PE ratios work best. They're most useful for profitable, established companies with consistent earnings. If you're comparing 2 retail chains or 2 restaurant brands, PE ratios provide valuable insight into which stock the market considers more attractive relative to current profitability. However, PE ratios have important limitations you must understand. First, they're meaningless for unprofitable companies. You can't calculate a PE ratio if earnings are negative. Many promising growth companies fall into this category, requiring different valuation methods entirely. Second, earnings can be manipulated through accounting tricks. Companies might time expenses or revenues to smooth earnings, making PE ratios less reliable. Additionally, one-time events like asset sales can distort earnings, creating misleading PE calculations. Third, PE ratios ignore debt levels entirely. 2 companies might have identical PE ratios, but one carries massive debt while the other has no debt at all. The debt-free company is clearly in a stronger financial position, but the PE ratio won't reveal this difference. Cyclical companies present another challenge. A construction company might show a low PE ratio during an economic boom, suggesting it's cheap. But if the economy enters recession, earnings could plummet, making that seemingly attractive PE ratio meaningless. So how do you use PE ratios effectively? Start by comparing companies within the same industry and similar business models. Look at both trailing and forward PE ratios to understand how the market views future prospects. Consider the company's growth rate. A PE of 30 might be reasonable if earnings are growing 30% annually. Always ask yourself why a PE ratio is particularly high or low. A bargain basement PE might signal hidden problems, while an extremely high PE could indicate unrealistic growth expectations. The market isn't always right, but it's rarely completely wrong either. Remember that PE ratios are just one piece of the valuation puzzle. They work best when combined with other metrics like revenue growth, profit margins, and debt levels. Think of valuation as detective work. You need multiple clues to solve the case. As we wrap up, let's review the key takeaways. PE ratios measure how much investors pay for each dollar of earnings. Trailing PE uses past earnings, while forward PE uses future predictions. Industry context matters enormously when interpreting these ratios. PE ratios work well for profitable, stable companies, but can mislead when applied to unprofitable firms, highly cyclical businesses, or companies with unusual earnings events. Always compare within industries and consider growth rates when evaluating whether a PE ratio represents good value. You now have your first valuation tool in hand. Practice calculating PE ratios for companies you're interested in, and always ask yourself what story the numbers tell about market expectations. In our next session, we'll explore additional valuation metrics that complement PE analysis.